Worried that setting your investment risk level means staring at complex charts and making decisions you don't understand? It's one of the biggest hurdles for new investors, determining how much risk is right for you. Taking too little risk can mean your money doesn't grow fast enough to beat inflation, but taking too much could lead to sleepless nights. Fortunately, platforms like Nutmeg make this process simple, transparent, and user-friendly. In a matter of minutes, you can be placed into a globally diversified, ready-made portfolio that perfectly matches your personal risk tolerance. Here's the breakdown of how Nutmeg helps you set your investment risk level. 1. The Risk Assessment Questionnaire. It all starts with a smart, simple questionnaire. Nutmeg guides you through about 10 questions designed to understand your personality and financial situation, such as: what is your investing goal? Is it for a deposit on a house in 5 years or for a retirement pot in 30 years? Your time horizon is a huge factor in how much risk you can afford. What is your reaction if your portfolio drops by a certain percentage? These questions gauge your emotional comfort with market volatility. What is your current financial situation, and do you have an emergency fund? This helps determine your capacity to take on risk. Based on your answers, Nutmeg provides a recommended risk level, typically on a scale of 1 to 10, or categorized from cautious to adventurous. 2. Understanding the risk levels. Once you have your recommended number, Nutmeg clearly shows you what it means. A lower risk level, like a 1 or 2, means your portfolio will be heavily weighted towards lower risk assets like bonds, which are generally more stable but have lower growth potential. A higher risk level, like an 8 or 9, means your portfolio will have a much higher exposure to stocks and equities, which offer greater potential for growth over the long term, but will also experience more ups and downs along the way. Crucially, Nutmeg shows you a projection of potential outcomes. You'll see a likely high growth scenario and a likely low growth scenario for the risk level you select, so you can visualize the best and worst case results before you commit. 3. Choosing your investment style. Finally, you'll pair your risk level with an investment style. Your choice here determines how your portfolio is managed, which in turn affects your fees and the risk-adjusted returns. Fully managed, this is Nutmeg's actively managed option. Their in-house experts make tactical adjustments throughout the year to help keep the portfolio on track in changing market conditions. This has a slightly higher management fee, but the active decision-making is designed to manage risk more dynamically. Fixed allocation, this is the lower-cost option. The portfolio is set to the same risk level and asset allocation at the start, and only automatically rebalanced once a year to keep the risk level consistent. It's more of a set-it-and-forget-it approach. The platform allows you to adjust the risk level up or down from their recommendation if you feel differently, letting you take control while providing all the educational context you need. You're never locked in, and you can always revisit your risk level as your life and goals change. It's about making an informed decision that lets you sleep soundly, knowing your investments are aligned with your financial future. With that said, thanks for watching, and until next time.